Hi there, welcome to GrainTV. It's Tuesday, March 1st, a new month, but with little different results in the grains. Let's take a look at the Grain Edge trading platform and see where we closed. In Chicago, corn and beans continued their 6-day losing streak, giving up 1.25 cents on corn, 3 cents on beans, and wheat taking it on the chin with a 6-cent loss on the day. News today was pretty light. There was some positive news to start the day with U.S. soybeans getting a bump from exporters selling 140,000 metric tons of soybeans to unknown destinations. And while we traded 5 cents higher in the night session going into the morning break, we were not able to hold those gains and in fact traded lower after soy oil really took it on the chin somewhere in the middle of the trade session. You know, overall, this is a market that is continuing to grind lower and try to test the lows that we established back in January. Let's take a look at the May soybean contract on the dailies. We've been looking at corn, and in the case of soybeans, the chart formations are very similar. We're getting down to those lows that we established back in January. In soybeans, the May contract traded as low as 853.5 and had some activity at 856 in that January period. We're not quite there yet at 858 on May beans, so we still have a little bit lower to go. Meanwhile, corn is getting down to those lows and really close to testing the low at 354. So, you know, pay attention to the next few days to see where we go. If we're going to break down below those lows, I don't think it's going to be a pulse lower. I think if we do break below it, it's going to be more of the same, just continuing to grind a little bit lower. There are some positive things to gravitate towards. First of all, let's talk about after the close today, and that was USDA's soy crush numbers for January. We saw those numbers coming in at the high side of expectations at 160.4 million bushels for the month of January. Not a big difference from expectations, but nonetheless on the high side, where expectations range from 159.2 to 160.5. So probably not enough to really get this market churning higher, but certainly maybe enough to at least establish a floor when you consider that we had this really good export sale at a time of the year when we normally don't. We see most of our business turning to South America. The other thing that I think is supporting or may be supportive in the corn market as we move forward is the lack of export competitiveness with Argentina that we had been facing for much of our post-harvest marketing season. If we look at U.S. and Argentinian corn prices, we know that in December, after Argentina's new president took office, there were some significant changes in policies, not only to removal of export taxes on corn, but also in reducing or letting their currency float, which reduced their currency value against the U.S. dollar. Both of those factors contributed to a very weak Argentinian corn price versus the U.S. And you can see that here in purple. The Argentinian corn price was substantially below the U.S. corn price in that December and January window. Now, keep in mind, that's a time of the year we're usually dominating the world market because it's our post-harvest season. Not true this year. However, the good news is, since we've gone to February and into March, we're actually seeing our price, as a result of the slide in the board, we're seeing our price actually start to be a little bit below Argentina. Now, I'm not sure that will persist once they get past their harvest into the next month, but at least in the time being, it is certainly positive to maybe set a floor on this corn market if we can start to see some new export business pick up. Certainly back in January, when we tested those lows at the 350 mark for May corn, we had a much different competitive situation in the export market. We were suffering. We were high priced relative to Argentina. Now, as we come down to those lows in the 350, that is not the case anymore. We're actually in a very favorable position to maybe pick up some business on this dip down. That's all we got for today on GrainTV. As always, visit us online at grainhedge.com if you're interested in learning how we can help you in your grain marketing situation, or always pick up the phone and give us a call, 877-472-4607. Silver right now is at historically low levels. Starting with the financial crisis of '08, silver prices made an epic run from $10 an ounce to $50 an ounce in just 3 years. Silver looks poised to make another run higher. Here's why. Today's headlines show wide-scale economic risk, central banks using negative interest rates to stimulate economic growth, and the continued explosion of government debt around the world. All these factors are creating a flight to safety in physical metals. On the fundamental side, high mining costs limits new silver supplies, while demand for silver continues to expand through rapid use in cell phones, plasma TVs, and batteries. All these factors suggest taking action at today's prices before silver reaches $25 an ounce. Our precious metals desk at GrainHedge can educate you about investing in physical metals. Their goal is to put the most amount of silver and gold in your hands at the least cost. To get started, contact Rodney at grainhedge.com or by phone at 877-472-4607.